if you don't know where to begin, better ask when.
Shane, good to see you. We're kind of diving into the headlines today. Should you buy risky assets in your 401k? Potential changes could be coming to your workplace retirement plan. That's because President Trump recently signed an executive order. Here it is, that would pave the way for riskier assets to be included in your 401k. So what's new here?
Well, this is a change that the administration is pushing towards these 401ks. And ultimately, these decisions are still up to the 401k plans and the administrators themselves. But basically, what the administration is pushing here is to allow an increased degree of options inside of your 401k and allow for more choice, more tools, more options, as opposed to the handful that you're probably used to inside your 401k as it sits right now.
So essentially, you might get access to private equity. What is private equity exactly?
Well, private equity, there's a lot of talk out there about private equity, whether you like it or you don't like it, it is what it is. But basically, it's a company that pools investor dollars to then buy ownership stakes in large firms with the goal of driving profits and driving revenue, maybe getting in, getting out strategically, the like. So regardless of what you like of them or what you think of them, they're typically pretty good at making money. So you have the option then to use that as a tool to make more money inside of your 401k. Just make sure you're aware of the whole story, though, when you get involved with private equity.
Right. And that is the follow-up question. What do we need to know about the risks and rewards of alternative investments?
Well, whether it's private equity, crypto, real estate trusts, oil and gas, anything that you would consider an alternative, they do work a little bit differently than the things that we're used to inside of our 401ks or the more regular stocks, bonds, mutual funds, ETF type tools that we're used to investing with. They come with some more risks, some more involvement, some more ability to make sure you actually know what you're doing. And ultimately, that really exposes investors to a lot more risk if they don't understand completely what they're doing. So you have to make sure you're a person that's willing to deal with that risk, make sure your time horizon is appropriate, that you don't set yourself up for some future regret.
And also, we need to talk through the fees, right? Because private equity funds typically charge a 2% management fee plus 20% of profits, known as the 2 and 20 model. In a 401k, fees like that can be devastating over time, which is why critics say the biggest beneficiary of this change will be the companies that offer them, not the plan participants. What do you think?
Yes, I think these, all these companies that you would consider to be alternative investments, especially private equity, for example, this change just opened the floodgates for them to bring in billions more dollars from, billions of different 401k plans that exist out there. So I'm sure they're very excited about it. It allows them access to so much more capital and the ability to make a lot more money. So be careful who's really winning here. Those fees can add up quickly. 2% as a base fee is not necessarily cheap. And then if there's a 20% haircut on profits, again, that's pretty enormous and can really hold back the performance. So really just make sure you understand that. Look at how that's going to affect your performance over time. And again, it's all about the time in the market, though. If you have the time, it could make sense, but not enough time could be dangerous as well.
So who should consider buying these risky assets in their 401k?
I think it's people, again, that truly understand what they're doing, but more importantly, have this time to stay in the market, right? We always talk about how time in the market is so much more important than timing the market. And if you're someone that's entering the retirement red zone, that's the 5 years before, 5 years after retirement, you're no longer really about growth. That should not be your core focus. At this time, you need to be focusing on keeping what you have, maintaining it, starting to draw income from it, positioning it in a manner to take that income. And so growth at that point becomes a secondary priority. So those of you that have the time to let this money grow and grow and grow over periods of time, 10, 20, 30 years, that's who should consider a little bit more risk inside of these portfolios or these 401ks, not those of you who are approaching retirement or just retired.
Right. No, it's all about having a long-term strategy, which of course is what you specialize in. But Shane, if somebody would like to learn more about how they can at least invest perhaps in private equity, or, maybe they're curious about exploring some other alternative investments, what's the best way to reach you with questions?
Best way to reach us is online at our website or call us on the phone here at the office. Our website, though, is winstonandcompanies.com, or give us a call here directly at the office, 602-456-1928.
Great. Shane, thank you.
Thanks, Erin.
Got a plan for your retirement, 'cause it's just down the road. But if you don't know where to begin, better ask when.